Good evening, everybody. Happy Wednesday. Another weekly Wednesday webinar. It's on the way. We're so excited that you're here with us. This is the episode 2 of season 3, so we're so excited. My name is Eddie Villanueva. I'm your official MC of the 3Ws, the weekly Wednesday webinar. Please relax with us. Go get you some water, some coffee. If it's dinner time for you, bon appetit. If you haven't eaten dinner yet, please make sure that you start cooking while you're listening to the webinar. But we're so happy to have you here again. We got a great topic. It's a new year. We know that a lot of people want to start fresh. No pun intended. The topic is a fresh start, debt consolidation strategies. We know that everybody has debt. Sometimes people, it could get out of control, but we want to make sure that you learn some new tips this evening for you to control those debts. And here at the United States Senate Federal Credit Union, we have great experts that can help you consolidate your debt. Again, we got a great panelist team this evening. We have a surprise presenter. He's already been with us, but we're not going to introduce him because his time will come to shine. But once again, if you have any questions, you have any concerns or any comments, or you just want to say hi to us, please make sure that you use the chat feature and the Q&A feature as well. And as usual, like Andrea tells us each and every week, we're going to answer all those questions live at the end of the presentation. But once again, thank you very much. And I see a lot of familiar names on the attendees. So hi to you again. Thank you for being here with us once again. And I do see new names as well. So thank you very much. If this is your first time joining us, we want to make sure that this is not your last. We want to make sure that you enjoy these great topics that we can learn from together. 602, I keep my promise. Kimberly, I will pass the mic to you with the introductions. And thank you once again for being here with us in another weekly Wednesday webinar. Kimber, take away.
Thank you so much, Eddie. Great job. And welcome again to our valued members. I get to introduce everybody. My name is Kim Fridley. You know me by now. I'm the Membership Development Analyst. You know Eddie. Carrie, you know by now. She's our subject expert content creator. She's the queen. We have Andrea from our marketing department. We have my right-hand man, Milton. He is, you all know him by now. He is the membership development manager. He is my leader. He is my boss. He's an amazing person, tons of knowledge. And did I say Andrea from marketing? Yes. And then we have Elton. Elton is going to tell you a little bit about himself. So welcome to a fresh start. Take it away, Elton.
Good evening, everybody. Thank you for joining us for a fresh start. I did want to say, Kimberly, I think you're the boss. So I don't know about Milton being the boss, but you guys are great.
Oh, thank you, Elton.
Together. So this evening, we're going to be covering fresh start debt consolidation strategies. But I want to tell you a bit about myself. I am the consumer loan manager here at U.S. Senate. I have been in the credit union world for the last almost 17 years now, and loans are my passion. This is something that I enjoy day in and day out to help our members to find financial solutions for them. So this topic is near and dear to me. So I'm glad I was honored to be allowed to speak on this subject. And then at the end of this session, we're gonna have the Q&A. So any questions that you have during this time, please, if you can put them in the chat. No question is off limits. Anything that you want to ask, do not hesitate to share that with us. All right, so we're going to be talking about today's agenda, which is debt consolidations. There are different types of debt consolidation options. So we look at personal loans, credit card balance transfers, home equity loans, and home equity lines of credit or HELOCs. or short. And we're also going to be covering debt management plans and being able to understand the short-term and long-term effects when you're doing a debt consolidation, the pros and cons of a debt consolidation, its advantages and not and things that can be a detractor. And then we're going to share with you guys the resources page at the end of this, so you can find some additional guidance on this journey. So we're going to do like a high level explanation of what debt consolidation is and how it can simplify your financial obligation. Um, so we'll go to the next part of this. So a debt consolidation is simply put a debt consolidation when you are combining multiple debts into one monthly payment. Typically, this includes consolidating high interest debts like credit cards, personal loans, um, bills from medical procedures you may have had or hospital stays. And I do want to point out that the average credit card interest rate is around 25%. And there are some that go 27, 28, 29%, depending on the card type you have, especially those store cards like Lowe's, Home Depot. Those carry almost a 30% interest rate. So it does creep up if you don't keep track. And then the goal is to simplify your finances, which I know if I were to have a lot of debt, it would stress me out. Like life is stressful enough, and then when you're having to deal with finances, it can create an additional habit. And the goal is to potentially save money by securing a lower interest rate and or extending your loan payments so you can get some breathing room to be able to make things work for you. So an example of this would be, you have four monthly payments that total $1,000 across different cards. And each of them, has its own payment date. Each of them has its own interest rate. When you're combining those into one payment, you're gonna get a lower uh, monthly payment because you are consolidating everything into one, and you're gonna have a fixed loan amount, a fixed payment, and then a fixed interest rate. Versus when you have a credit card, your payments can fluctuate depending on how you use your card. It can fluctuate on if you are carrying a higher balance that month versus other months, or if you continue to charge it up, then that will affect your payment. And then when you're paying on a credit card, you're paying the minimum monthly payment. The minimum monthly payment, it just means that you're satisfying the interest portion of the credit card. You're really not making a dent on the principal balance that is outstanding. So that's why consolidating will make the budgeting process to stay on track easier. And then in the next few slides, we're going to break down how this process works and explore whether the consolidation is the right move for you. All right. So why do we consolidate? We can consolidate, first to, as I said, to simplify your payments. Instead of juggling multiple due dates and amounts, you'll make one single payment each month. The other benefit is you're going to have a secure, lower interest rate, which is fixed, not variable. And because most credit cards have a variable rate, meaning that if the Fed funds rate were to increase, then that adjusts your interest rate higher. And we saw that when the Fed increased interest rates, you know, over the last 18 months, how much that affected not just of the credit cards, but anything that was tied to the Fed funds rate, anything that was variable was affected by that. Yeah. And then depending on your financial goals, you can also adjust your repayment term. For example, you could choose a shorter term to pay off your debt faster, or if you want a more safe payment, meaning that you would rather be comfortable than stretched, then you can get a longer loan term, which gives you a lower monthly payment. And then if you have extra cash after you have verified your budget, you can apply it towards the principal balance on that loan. And then the big advantage of the debt consolidation is that it helps set a clear budget, which means that you already have a predictable monthly payment that you can plan for confidently. How many times, do we start to do a budget, but then you have so many variable um, payments and that are coming and going, and it can be a detractor sometimes to focus on maintaining the budget when you don't know from month to month what those payments will be. So this can also help you stay on track. And then also too, a debt consolidation can help your credit score in the long term because you are reducing the credit utilization, which is one of the big factors of how a credit score is measured, is what is the credit utilization? And you should have a credit utilization of more than 30% of your available limits before it starts to affect your credit score. And then, we want to make sure that we understand that debt consolidation is about taking control of your finances and reducing the stress overall. Yeah. So, we're going to go over some real world examples of, what average Americans, are experiencing. And this was a survey based on the U.S. News survey. They found that 69% of respondents reported their finances improved after doing a debt consolidation because they found it easier to manage the payments and reduced their overall financial stress. 59% were able to consolidate all of their debts into a single loan, okay, which streamlined their monthly obligations. That's huge. 50% felt less worried about their monthly payments because they significantly improved their financial confidence that that they could tackle this debt and this challenge. And then finally, 37% of respondents mentioned that consolidating their debt allowed them to free up income, which is a key step towards building financial security. And oftentimes, we hear about making sure that you have an emergency fund for that unexpected, because it's not a matter of if, it's a matter of when, and an unexpected expense may happen. And an unexpected expense doesn't have to be tragic. It could be you need new tires. And I can tell you this, I just put tires on my car a month ago. I did not know that prices had doubled essentially. So I paid $950 for new tires. That is, you know, an unexpected expense. That would be considered an emergency because I need my vehicle to travel to work, to travel to places. So I want to make sure myself and my family is safe. Right. So, we're going to look at, is consolidation the right thing for you? And the material that we're going over, this may not always be the best option for you, but we want to make sure we are presenting it to you so you have options to consider, and then you can make the best decision, based on what your financial situation is and the types of debt that you have. So, you know, debt consolidation, can be a good move if you have a good credit score, because this will allow you to qualify for a lower interest rates versus if you have social credit or I call it challenge credit, because you may not qualify for the lowest available rates. Uh, in the American consumer financial services industry, the credit score is king in the sense that even though someone may be paying for cash for everything, but when you need a loan, you need a FICO score, because the FICO score will determine what interest rate you're going to get. The FICO score does not determine whether you qualify for the loan or not, but it determines, will you get a favorable rate, or will you get a rate that may not be as favorable as to what you may have anticipated or expected. And excuse me, it can also be good if you carry high interest debt. So, being able to consolidate those 28, 29% interest rates that you have on your store cards, or just these reward cards that, they dangle these, bonus points when you sign up, if you spend the X dollar amount. But if you carry a balance, they carry a high interest rate. With the credit union world, um, by law, we cannot charge more than 18% on a loan. That may seem high, but where if you go outside of the credit union world, you will find interest rates as high as 36%. If you go to a payday lender, it's going to be 500%. So 18% is the max that we can charge by law. And also, too, the debt consolidation is good for if you have enough cash flow to make payments, because you'll be able to tackle it more comfortably. If you have that cash flow to support it. And the debt consolidation, is great, but you also have to make sure that you're changing your habits. Oftentimes when I'm counseling members, I I always preface, if you're doing a debt consolidation, you it's similar to somebody who files for bankruptcy. You can get this cleared, right? But if you don't change your habits, if you do not change the way you look at money, the way you handle money, then you're going to be in the same boat over and over again. So you want to make sure that you are, look inward to adjust some of the ways that you are spending. So being more disciplined, that's very important. Being able to research to find the best financial budgeting tools. If you need an app for that, I'm sure Apple Store and um, Android Store have those apps available for you to be more disciplined if that is what you need. Or you could just do it the old-fashioned way, pen and paper. Here's my income. Here's my outgoing expenses. How much do I have at the end of the month? You should be doing a zero-based budget, because if you allocate every single dollar, then that's how your budget is going to. And then you could do some more research on the $0 based budget to give you some ideas on those. Okay. And then, you know, to be able to prepare for a debt consolidation, you want to, make sure that you're doing a thorough financial review. First, you want to assess your current financial situation by listing your income, as I said, your monthly expenses, knowing what you're bringing, what you're spending. Uh, you need to It's like triage. You need to see, okay, what's happening? Why am I bleeding financially? So if you record every single expense that's happening, then you can see, oh, darn, I actually am spending more money than that's coming in. And the real one of the reasons is because nobody balances their account anymore. You know, back in the day, uh, consumers used to balance their checkbooks. Uh, I will tell you this: I have not balanced a checkbook in probably 18, 20 years myself. I'm young. I grew up in the financial world, so I know how to balance a checkbook and everything like that. But there's ways that you can still balance through budgeting apps and whatnot. So that's the most important. You have to do that financial review of, like, where do you stand. Creating a full list of your debts, which you want to list your balances, the interest rates, and your due dates. This will help you see the big full picture and identify which debts are most urgent to consolidate. And then setting a clear goal. Do you want more monthly payment to free up cash flow? Is your priority to pay off your debts faster? So you have to define which option works best for you. And then most important, and I think this doesn't get done often enough by consumers, is by law you are um, you are afforded 3 free credit reports per year through Experian, Equifax, and TransUnion. The credit report itself is free. If you are wanting that FICO score, there's a cost to that, but you don't really need the credit score. The reason why, because now you can look at your credit score on your on your bank app, on the credit card app. Every card that I have provides me a free score that, and then it gives me some ideas as to, why my score is that. But you want the credit report, and that's available at annualcreditreport.com, because that is going to show you what the creditors are reporting. Make sure you're validating the accuracy of the credit report. Mistakes do happen. There are debts that could be on the credit report that may or may not belong to you. um, Identity theft and fraud are something that is happening more and more, and it's expanding at a pace that, it's hard to keep up with. So you want to also validate that, you don't have any new accounts that don't belong to you. So those, and if you somehow see a collection that shouldn't be there, or an account that is reporting negatively and it should not, then the annualcreditreport.com also gives you opportunity to make a dispute through the credit report, because there are standards that are set up that if you do it through the annual credit report, the creditor has a time frame that they have to research, investigate, and then get back to the credit bureau and say, is this finding correct or incorrect? If it's incorrect, then by law they have to fix it. And then ways, to consolidate debt. So again, like we've been talking about the personal loan. Uh, Balance transfer is another option. so you want to make sure you are reviewing the balance transfer uh, promotions that are available, and most of the time you'll see them around this time, between January and March timeframe, because how the holiday shopping has concluded and balances are bloated. This is a way that the consumers can consolidate some debt. Balance transfers, depending on the credit card that you transfer it to, uh, have those teaser promotional rates. But then you also want to look at, once my interest rate offer expires, what is going to be my go-to rate? Also, is there a balance transfer fee? Because that can eat into any savings that you're thinking about. So if you get a 0% for 12 months, but the balance transfer fee is 4 to 5%, well, you're paying 5% upfront, to be able to get that 0%. So if you don't pay that debt in 12 months, then you pay 5% plus what the go-to rate is on that card. So those are things that you have to look at. And that's good for maintaining of flexibility. We have on here the without fees, but you have to make sure that they don't charge fees, because most of them that I've looked at, they do have that balance transfer. A home equity is another option where you can use your home equity as collateral to secure a line of credit. If you don't have one already, you could look at that, because it's something that you could have open and available. You don't have to use it, and there's no requirement that you have to use it. It could just be sitting out there, and those are suitable for if you want to tackle larger debts, or if you're going to do, like, other projects in your house. And the other option is the debt management plan. So you work with a credit counseling agency, and this is best for people that may not always qualify for the options, for the three other options I just mentioned. And we're going to take a closer look at the personal loans. And so where you're using it to get a fixed rate, to consolidate higher rates, you're you are going to lower the monthly payment, because you can stretch it out, which gives you a more comfortable payment. What I recommend is, if your goal is to get out of debt, if your goal is to do a debt consolidation, I would try to keep it no more than 3 to 4 years. If you can handle a 3 year repayment, that's great. For at the most, because every year you add after that, you are going to be adding interest that is going to. So the longer term you have, the more interest you end up paying. And the goal is to get out of debt quickly and reduce interest. That's how you save money, is when you try to pay off something more quickly, because the cost of credit is going to be less on a shorter term than a longer term. Perfect example of this would be a home mortgage. If you do a 30-year mortgage, the payment is more comfortable. And oftentimes consumers think, if you go to a 15-year, the payment is going to be double what the 30-year mortgage payment will be, and it's not, because you're cutting 15 years of interest payments. Your payment is going to be higher, but it's not going to be double what it would have been if you went with a 30-year loan. So that's like a perfect example of if you want to cut interest, shorter term always works better. And with With personal loans, most of them, especially here at U.S. Senate, we have no origination fees. There are other financial institutions that may charge an origination fee, so make sure you do your research on that. And we also have no prepayment penalty. So you could get the loan tomorrow, and if you want to pay it off early, you can pay it off in 12 months or a month or 2 years. There's no prepayment penalty because you only pay for the interest for the time that you have had the loan. All right, so Visa balance transfers. So at US Senate, we offer our smart rate Visa. This is a zero balance transfer fee. Normally, as I said, the other credit card companies it used to be 3%, but now I've seen more and more of them are charging 4 to 5% in order, to make up some of that um, income that they will lose on the 0%. Because there are consumers who will pay it off in that 12-month period or 6-month period, but you have to be very, very disciplined. If you're going to do one of those balance transfers, you have to be disciplined. If you forget to pay it off before the promotional offer, and you have to strictly budget. So an example would be like, if you transfer $10,000 to a XYZ card, you're going to be charged between $300 to $500 in balance transfer fees. With US Senate, you have a zero balance transfer fee. So, you have to take everything into account. That $300 to $500 that you're paying, if you were to go with a card that didn't have a balance transfer fee, but has a higher interest rate for the promotional offer, does it still make sense? And there's free calculators out there on the web that you can definitely look to see. Okay, where you can do some examples to find the best option. Okay. And then, we have a no annual fee. There are cards out there that charge an annual fee. There's a lot of rewards cards that are starting to charge fees. I know hotel cards, airline cards, they all have that annual fee as well. So, another thing to consider is that if you're doing a balance transfer. And then also too, you want to look at the penalty APR. Um, Banks make their money, and credit card companies may make their money from fees here at US Senate. And we try to not fee our members to death. We've actually removed a lot of fees. One, as a credit union, we have low fees in general, but we have removed a lot of fees that may have been associated in the past because we want to give our members the financial freedom to make the best decision. And our goal is, to put money in your pocket, not take money, from your pocket. All right, so we're going to briefly talk about home equity loans and how they can be used for debt consolidation. Home equity loans, uh, these are fixed rate loans, so you borrow a lump sum based on the equity in your home or what you qualify for, and then it comes with a fixed interest rate. You have a fixed monthly payment, so that you know what your payment is going to be, and it's predictable. This is ideal if you're consolidating large amounts of debt, such as credit cards, personal loans, medical bills. I don't recommend consolidating vehicle loans into this. In my past experience, I've had to counsel members to have them understand. that if you do a 10-year or 15-year home equity loan and you consolidate a vehicle loan into you're essentially consolidating a vehicle for 10 to 15 years. Most consumers don't keep their vehicles for 10 to 15 years. The average vehicle is being traded in every 18 to 24 months. So, now you have debt on your home equity loan for a vehicle that you may not have in 5 years or 10 years, for example. So, and also too, it's a depreciating asset. It's not something that keeps its value. So it doesn't always make sense. But at the end of the day, the consumer makes that decision. But I gave you the financial guidance in these matters. So, for example, if your home is worth $400,000 and you owe $200,000, then you may qualify to borrow a percentage of that $200,000 in equity. So here at U.S. Senate, our loan to value of maximums are 80%. So it'd be 80% combined between the first and the second. Or if you have a first, then if you don't have a first and you're doing a home equity for the first time, then you'll be up to 80% of that home value or whatever you may qualify, because there's other factors, not just the loan to value. There's your debt to income ratios play a part into it as well, because you could have $200,000 equity, but if your income does not support a 200, Porsche, say $100,000 home equity loan, then you may qualify for a lower amount to make sure that we're not hurting you as the consumer, because we're not in the business of taking collateral or being um, homeowners. We want you to be the homeowners. And also too, with the home equity, you also have to understand that since you have your home as collateral, if you do not if you do not make your payments on time, or if you fail to make payments at all, then you put your home at risk as well. So you also have to make sure you're budgeting to to make sure that you don't get behind on that. And then the other option is called our home equity line of credit. This is a variable interest rate line of credit. You can have a line open. For example, say that the limit on this line is 100,000, but the balance is zero. And then you'll only pay when you do a draw, like against that 100,000. So if you drew 10,000 and put that into your account, then your balance now is $10,000. So you'll pay interest and payment on that 10,000 outstanding. You pay it off, or as you're paying it down, then your available balance goes back up as you're making those payments. The home equity line of credit, the rate is variable. So it fluctuates based on what the Fed funds rate is. Um, the Fed funds rate has gone down slowly in the last 6 months, but it's still like our current interest rates for the HELOC are 7.5%. You know, still better than they were when it was 8.5%. But again, they're slowly coming down, and they may not be going down as fast as when they went up prior, because all of these are factors that economic factors that can play into it. And then also too, you'll have the ability to have a 10-year draw period. So what that means is like you can use your line of credit for up to 10 years. You could draw from it back and forth for 10 years. Draw, pay off, draw, pay off. and then like you have a 20-year repayment cycle. And then we also offer both our traditional home equity line of credit, and then we also have an interest only payment option as well. All right, so the debt management plans. This is, again, this is an option for someone, who may not qualify for the traditional loans. And then this is counseling agency. So it's a credit counseling agency, and the credit union has partnered with Green Path Financial Wellness, which is a nonprofit organization that helps individuals create personalized repayment plans. So they'll give you debt counseling uh, assistance, and then they will create a plan for you just based on the interview that they have, and what cards you want to consolidate, what debts you want to consolidate, and then they'll walk you through the benefits of doing a debt management plan, the cons of doing one. There's no credit score requirements. You'll have one payment for simplicity. You're going to have a clear payment timeline. However, there are a few points that I want to make, because accounts that are included in the payment plan will be closed, because this is done to ensure that you're not utilizing this debt, because otherwise you'll never be able to pay it if you go through this plan, but then you still have it open, and you're still using it. Also, too, this will show up on your credit report, and it will say account managed by debt management. When you are under a debt management plan, you should not be getting any new debt at all, because there's a reason why you went through this route, because you needed assistance to be able to manage your debt. So you shouldn't be getting new debt when it comes to this. And then, there is a small setup and maintenance fee, which is regulated by state law, and it varies on the state that you live, but it shouldn't be no more than $75. And so if you choose a debt management plan, it's not free. There is a cost associated, but you have to talk to Green Path to determine what that will be ultimately. But the debt counseling is free. Okay? And when it comes to debt consolidation, as I shared with you guys earlier, is you want to take into account these key questions. Does it affect your credit? Can you consolidate a debt if you have bad credit? And we're going to address both of those things. First, does a debt consolidation affect your credit score? Absolutely. But how it affects it depends. The reason why it depends is because uh, one is going to result in a hard inquiry if you go through through a if you go through a debt consolidation. So this can lower your credit score at least 5 to 10 points at a minimum. I've seen it higher, depending if you've been shopping around and it looks like you're a credit seeker, that can affect it more per se. And then usually, this will recover after several months. And then as you're paying down your debt, you'll have less balance, and that helps reduce your utilization of unsecured debt, because your credit score is also made up of a mixture of credit as well. So you want to make sure that you don't have all unsecured debt, and you have a mixture of debt. Otherwise, if you only have unsecured debt, credit card revolving debt, then that's going to negatively impact your score more than if you had a mortgage, auto loan as well, too, or other secured loan. And then also too, you're going to be lowering your credit utilization, which that can boost your credit score on the other end. The goal is to make sure that you are not reusing those limits again, because oftentimes that's a mistake that happens is, oh yeah, I just cleared $30,000 in credit card debt into one loan, so now my limits are back to available, and you have the temptation to use it again. And so if you use it again, so you have $30,000 outstanding, then now you racked up another 30,000. And in today's society, $30,000 can easily be racked up quickly with all the consumerism that is out there. And then you want to make sure that, sorry, and then you want to make sure that, is the debt consolidation a smart move? So you want to, if you're consolidating, is it going to be beneficial to you? That is something we need to look at. Are you going to qualify for a lower rate than what you're currently paying? So that's another thing that you want to take into account as well. And then the consolidation, is going to be a smart move is if you have that consistent income. If you are like a regular wage employee that has a consistent salary, then this may be a good option for you. But if you are 100% commission, or you have to hustle, as a self-employed individual, you may have, feast or famine months, and are you able to handle these types of payments as well? And then if your goal is to pay off your debt more quickly, then you want to consolidate into more favorable terms, as I say, the shorter term, the better. But a debt consolidation is not always the best option. And then if you can't commit to the consistent payments, then this is not something that works for you. If you have a low credit score, you may not get the best and most favorable loan terms. So if you don't have a lot of debt, that makes sense to consolidate. Maybe again, you should, before you even do a debt consolidation, you should be starting at a budget, creating a budget so you can see, okay, what's coming in, what's going out. And then if it's something that you can tackle without going through the debt consolidation process, then that's what I would recommend. Some of the ways that you could do that is the snowball method, or the avalanche method, is where um, you are tackling the highest interest rate first. If you do the avalanche method, and then the snowball method is if you're tackling the smallest uh, balance first, and once you pay off that small balance, then you are going to the money that you're using on that just paying debt, you're going to use it on the next debt and the next debt. That's what they call the snowball, because it gives you those small wins. And then when you have that big balance that you have to tackle, it's more attainable because you've already paid those five other debts, and you can just focus on this. And then if you plan to continue using the high interest credit cards after you consolidate, then this is not an option for you, because again, you will not learn anything from this, and you're just going to put yourself in a worse financial situation. And then lastly, our resources that are available to you. We have Green Path Financial Wellness. You can find them at greenpath.com/USSFCU, 877-337-3399. And then USSFCU also has a wellness center at ussfcu.bonsai.org/wellness. And these would be great resources, to utilize define some options if you don't want to go through the debt consolidation route. Okay. All right, questions for anybody?
Yes, so we have a few questions. So the first question is, what are the I can't talk. What are the criterias for qualifying for a debt consolidation loan?
What are the criteria for qualifying for a debt consolidation loan? Yeah, so it all depends. Credit score is definitely looked at because that's going to determine what your interest rate is. The loan term matters because then again is going to affect your interest rate because shorter term has lower interest rate than longer term. We look at uh, current and prior payment history, especially within the last 24 months. How have you been paying on if you're asking for unsecured debt? How have you been paying the unsecured debt in the past? Um, we look at reutilization of credit. We look at your debt to income ratios. Do you have a lot of open credit? That's also a, a factor because you most of the time you could be sufficiently obligated, meaning that you have so much open credit. Why are you coming for debt consolidation when you could be utilizing your current available credit that you have as well? Um, Employment history matters. Your your amount to live on matters because how are you going to be supporting to make this payment? Inquiries. Have you had a lot of inquiries in the last 24 months? So those are things that we look at as well. Are you a credit seeker? Do you constantly need to have a credit card, credit card, credit card? I mean, I've seen borrowers have limits available of 300 to 400,000. Okay, I was like, there comes a point where you have enough. You really don't need this as well. So there's a lot of factors that go into what we review as well.
Thank you. And our next question is, opening several balance transfer credit cards to pay off high interest rate card is not a good idea when you apply for a consolidation or a personal loan.
I would agree with that statement.
And
Yeah,
what are the best ways to pay off a credit card debt?
personally, like I always try to put myself in the consumer's shoes, and the financial advice that I give consumers is the advice that I give myself. And first thing that you have to do is you have to start with a budget. That goes without saying. That is where you should start. That is your step one to uh, write down all of your expenses, and those expenses include that Netflix subscription too. It's not just the debts that it's not your car debt, it's not your rent, it's not it's those small things that get away from us and that we don't realize we because it's on automatic payment to your card. So anything that is coming out of your income needs to be factored in. And then from that point, then you can determine, okay, do I have enough debt to consolidate to do a debt consolidation loan, or can I tackle this myself? You know, if you have small balances, here and there and everywhere, you can probably tackle those yourself once you determine what your budget is, and then if you're supposed to have $500 a month extra, but your checking account does not reflect it. So that means that means you don't know where your money is going because maybe you're eating out more than you should be, or you're buying things that you don't necessarily needs. So if you cut some of those out, then that $500 a month you can easily apply on the smallest card, and then do the same thing until you end up paying those things. So that's where I start. Before I even do it, before I even go to a financial institution, that's where I start, and then that's the method that I
That's great advice.
would.
The next question is there a way to negotiate the debt total down?
It depends. It really depends. It depends. The reason why I say that is depends if the debt is in collection or charge-off status. Because at this point, your credit is already challenged, and it can't get any worse in that respect. So you can definitely negotiate to get the lowest settlement. Uh, but they typically, give you a short time, to make that payment. And I always recommend never use your personal checking account to pay, that debt, because then they have your account information. And I usually, I'm skeptical of like providing somebody my account number anyway when it comes to uh, collection agencies in general. So you can definitely negotiate. But if you don't have the credit challenges, then you want to make sure you can also call the credit card companies if you have, and I'm using an example, I'm not advertising for them or anything like that, but I just know like in the past, I've helped, my family with this where I called Capital One and I said, there's been a job loss, in the family. Can you lower the interest rate on this card? Most of the time they will. Some of the time they won't. But if you don't ask, then they're not going to do anything about it. So the worst thing that you could hear is a no. But oftentimes, they will work with you. If you say, hey, I'm struggling financially, I want to, make sure I keep paying on this account. I don't want to go past due. You know, can you assist me with lowering the interest rate? So the first thing I always say, is reach out to the financial institution, whether it's someone else or us, and say, hey, I need some assistance before you get too far behind.
Absolutely. That if I may add also to what Elton was saying, I absolutely give that advice as well too. Oftentimes, you'll never know. There are a few credit card companies out there that they provide a hardship program. So they might not be able to lower the interest rate, but they might be able to give you back some of the fees and perhaps structure a plan so that you can get out of debt as well. And as you can see here in the screen, we do have our partners at GreenPath. They do provide a debt management program that in essence, they will do just what we just told you. Find a way to negotiate and bring down some of the interest, cancel out some of those fees, as long as you have a plan established, to pay down the debt. But hopefully, you're not at the point. And if your credit hasn't been impacted, we highly encourage you to reach out to us and see what we can do here for you at the United States Senate for Credit Union. Do we have any more questions, Andrea? All right.
Yes, we do. So I believe this is our last question. Will consolidating my debt affect my credit score? If so, how?
Yeah, so it can potentially affect your credit score, because one, you're doing a hard inquiry. Two, you're adding a new debt on the credit report. Um, so that's a new account, and oftentimes when you open a new account, uh, it does negatively impact your credit score. Uh, Try not to focus so much on the credit score, either because if this is going to financially help you, be at a better situation in 12 to 36 months, then that should be your focus. Short term, it's going to impact your credit score, but it's not going to impact it in a way that, it's going to prevent you from getting a home loan or an auto loan, as long as, you qualify, for those programs. And again, the key is debt consolidations work as long as you are disciplined and you don't rack up the debt again. That's the key, and that's the hardest thing for consumers to really follow. And that's what's like if you intend on racking back up and and you could tell yourself all day long, I'm going to be better at managing it. Now that I have one payment, if I use my credit card, I'll be able, to pay it off that month. Life happens, and when life happens, whatever you anticipated may not go the way you thought it would. So debt consolidations, great as long as you are very, very disciplined. And again, I can't stress over and over again, budget, 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 budget. It's this if you wanna get out of debt, if you want to stay out of debt, if you want to be financially independent, you have to budget. You have to know where your money's going.
Awesome. Thank you so much, Elton. We truly appreciate you taking your time. We know you're a busy guy. We most definitely appreciate you coming in and giving your expertise on this amazing
My
presentation.
pleasure.
I would also like to say that we do know we have members in the West Coast. Some of them that have been impacted by the fires that are going on in Southern California. So our thoughts and prayers go out to you all. Please let us know if you've been impacted. Give us a call. We will be more than happy to see what we can do. If anyone here in this presentation has been impacted, please give us a call. But we really hope everyone is doing fine. And with that being said, would like to remind everyone of the webinar that we have coming up next week, which is the Great Wealth Transfer, how to pass and receive wealth. So if that is something that you're interested, please help us spread the word. We would love to have you back again next week. It's going to be another exciting webinar, especially for those that are looking to maximize your savings, how you can create wealth for the future. And if so, do you have a plan established? God forbid something happens to you. So come on in and join us next Wednesday. And with that being said, do we have anything else we want to share for the good of the group, guys? No? I think we're good. Again, Elton, thank you so much, and I hope you all have a wonderful evening. We'll see you all next time.
Thank you, everybody. Have a good
much.
night.